Yeah, absolutely. Hey, so super excited about this today. You know, one of the things that we've always done, and Sue, you kind of hit on this with our passion just for people building wealth through real estate, and it really does start with number one, getting their credit line, which we're going to be hitting on here in a few weeks, but then number two, the fastest and best way to build financial wealth is real estate. And the challenges in a market, especially with first time home buyers, a lot of times their down payments limited, their income's limited, and so it's hard to get a start with that. And I'm super excited for Will to be talking about the THGCA program today, and really a way to help our clients get into home ownership faster and at less expense. And you know, you guys may not know this, but Will is an absolute expert on all of these down payment assistance programs and first time buyer programs and just techniques to get these buyers into homes. So super excited to have Will teaching on this today. I am going to be on mute because I've got some noise around me, but Will, we're super excited to have you teaching and tell us everything you know in the next 45 minutes.
Okay. So, hey guys, good morning. I'm super excited to talk about this. I'm real passionate about first time buyers. They need all of our help. If I wanted to start today a little different, I wanted to ask you what you think the primary problem for first time home buyers getting into houses.
Money.
Down payment.
Okay. So I'm having this conversation a lot, and there's always some resistance, and the question surrounds affordability. We've all seen homeowners insurance go up, property taxes go up, prices go up, and interest rates go up. So the affordability issue is a significant one. It's causing a lot of anxiety. So I wanted to take a chance to talk about a specific down payment assistance program. So I'm going to touch on some other things, and I'm going to try to keep it to 30 minutes or less today, so you guys can go enjoy your Friday. But there is a down payment assistance program through TDHCA. So embedded in their program, and I'm going to scroll through this. Sue, are you controlling the presentation?
I am, but I'm going to have to stop it a second. For some reason, I've got two in the waiting room and I can't admit them.
Okay.
So if you don't mind real quick, let me just see if I can't get them going. And so sorry about that.
You're also scrolling through the presentation?
Oh, I am? Oh, good. Well, do not look ahead, people.
Okay.
Well, you're gonna have to speed up your speech to keep up with that.
Yeah. Well, we'll be done in about 30 seconds based on Sue's pace.
Okay. Sorry about that. It's when you're operating all of it, it just kind of, there we go. Okay, go ahead.
Okay, you can move to page 2. So down payment assistance programs are designed to help first-time home buyers cover expenses associated with their down payment or their closing costs. Because these programs also, you can combine them with a VA loan or a USDA loan that doesn't require a down payment. You can use the assistance to cover the closing cost, and the buyers have an opportunity to actually get their earnest money back at closing. So there's opportunity on a couple different loan programs for them to be out of pocket a very small amount. So hopefully this helps overcome that objection about, I don't have money. I can afford the payment. I'm paying $2,500, $3,000 a month in rent. I can afford the payment, but I just haven't been able to save any money. So hopefully this presentation helps overcome that objection and provide some data for you guys to talk with your buyers about. Go ahead, Sue. The presentation's gone, Sue.
Okay, I think I stopped sharing my screen for some reason. I don't know what's going on with my peoples today. Let me see here. Well,
while Sue's working on that, I'm going to go through the highlights of the presentation. So you have normal down payment assistance programs through Seth, through TSHAC, and through TDHCA. And in those programs, the assistance is forgiven after 3 years. So if they stay in the house and don't refinance, that assistance is forgiven. So the downside to that is they're going to pay a higher interest rate. They're going to pay a premium to have that benefit of the assistance being fully forgiven. So within TDHCA, there is a program specific to targeted areas. So, and those areas are targeted by census tract, and it's typically lower to moderate income areas. And with that program, if you're in that targeted area, there is a program that has the interest rate of 5.5% for a 30-year FHA, VA, USDA program. If you can qualify for that. So there's some caveats in qualifying. You have to be a first-time buyer. You have to have a minimum credit score of 620. It has to be a government loan program, such as VA, FHA, USDA. TDHCA determines the fees because they are really the lender. We're almost acting as a broker. So TDHCA controls the fees, and I would say that TDHCA is cheaper on fees than a down payment assistance program such as TSHAC. So there's some advantage there with lesser cost. The down payment assistance with this program with a targeted area, it is fully repayable. So that's why they're getting that lower interest rate, because the assistance is fully repayable. So when the home is sold or refinanced, that 3% assistance, let's say it's a $300,000 loan and they're getting 3% assistance, so they're getting $9,000. That $9,000 is fully repayable when that home is sold or refinanced. And they've got two different options. They've got 3% assistance at 5.5 and 4% assistance at 5.875. Okay. So the targeted areas, it's a little unique. So the website, you can put in an address to this website. Okay. And it's on TDHCA's website, and it gives you a census tract. And then you cross-reference that census tract with the list of targeted areas. So this website is not going to show you if it's a targeted area. It'll just show you the census tract, and then you have to check that census tract against another document that they have. So, and I think everybody on this team would be happy to check that for you. It's really simple. We already have the materials in place. That way you don't have to do any extra work. Is we can punch this address in and then cross-reference versus the targeted areas sheet. So, and Paul, I see your question. That's a great question, and I'll find out the answer, because it's a little bit different because it's a government loan. You know, on a conventional loan, only one buyer has to be a first-time buyer to qualify for that assistance. So I will double check on that, and I'll get back to you after the call. Is that fair? Okay. As we continue, again, there's a big difference in the programs versus fully repayable and fully forgiven. And that, with the fully forgiven down payment, the down payment assistance, you pay a premium in the interest rate to have that money forgiven. So I put together this simple kind of breakdown. If you were using standard down payment assistance that's fully forgivable, the interest rate today is 8.125%. On a $300,000 loan, that principal and interest payment is $22.27. Where if they are buying in a targeted area and they are at $300,000 at 5.5%, that payment is $17.03. So this program allows buyers to save in this scenario, $524 a month. Okay, that's a huge win for the buyer. So if you calculate out $524 a month by 18 months, they will have saved enough money to cover the cost of that repayable assistance. So because of the savings every month, I think it's a huge win, a huge opportunity, regardless if it's repayable or not.
Well,
With
I
that,
know the answer to this, but others may not. What can you use a buy down program with this?
no, you cannot use the buy down program with down payment assistance. So, but you can combine it. You know, if someone's doing an FHA loan, you can structure it to get them in the house with no money. You can structure it with a 3 to 4% down payment assistance program, and then ask the seller to pay closing cost. So on all government loans, the buyer is allowed to get their earnest money back at closing. So there are opportunities to structure a loan and structure a contract to have the buyer bring less than 1% total to closing. So I think there's opportunity for buyers with these programs. Okay. And I know this isn't very complicated. I'm gonna run through the caveats again. And remember, you're typically a first-time buyer. Minimum credit score is 620. You have an income limit for a family of 2 people or less of $123,720. If you have 3 people in your family living in the household, the income limit goes up to $144,430. This down payment assistance program has the highest income limit of all programs available. Again, the assistance is a 30-year, 0 interest, fully repayable loan for that 3 or 4%. Okay, so if what we think is going to happen will happen, which with interest rates drop here in the next 24 months, demand will surge, values will go up, and that increased value will allow them to have the equity to pay back that loan if they want to refinance or sell the house. So it won't have a detrimental impact on their equity or loan to value. So those are the caveats of the program. There's some other options out there. Benchmark has a grant program that will offer up to $1,500 to cover down payment. The caveats for that program is the income limit's about $77,000. They have to be a first-time home buyer. There is no targeted area caveat in that program. So that's really income-driven. That's an income-driven program and a first-time buyer program. We also partner with Chase on a community lending product, which is driven by targeted area and income. On that product, the buyer, it's a conventional loan, 3% down. When they qualify for that program, it eliminates all the loan level pricing adjustments that made all the noise in March. All those pricing adjustments go away. So the interest rate for the same program is typically about a 0.5 point lower than market rate because all the loan level pricing adjustments are removed. So we're discussing these options with every buyer. What box do they fit in? Because every buyer has a different financial position. It's not cookie cutter. So we want to find the best programs to help them accomplish that long-term goal. Okay. I told you I would try to keep it short. Does anybody have any questions?
Will, how about the locations of these properties? Is there any general areas that you could share?
Yeah, that's a great
all
question.
All of McKinney out of the question?
Yeah. So there's only one very small census tract in Collin County, right? That's it. And I think it's on the east side of 75. That's the only census tract in Collin County.
Oh.
But there are over 100 available census tracts in Dallas County that meet this requirement. So I think you're going to find those census tracts on the outside of 635, on the east side of town, in Mesquite, Garland, in that area where most of those census tracts, up and down I-30, where those census tracts are going to be.
So the process is we get those properties, say, hey, Will, Sue, is this one of those? And
Correct.
you-
Like I'm happy if there are addresses that you want to check to see if qualify, even if they're on your listing, because this could be a great marketing. If you have a listing that falls in the census tract that the buyer is going to qualify for this program, that there's opportunity there. So anytime you have an address that you want to find out if it meets that requirement or isn't that targeted area, I think we're happy to do that since we have the resources at our fingertips already. We don't have to go search for it, right? We have all this stuff saved on our computer. Just a simple text message sending the address to see if it's in a targeted area, we can get you an answer in 5 minutes.
One last question. Is this like the one we did together in, I guess it was late May, early June?
Yeah, so that's a great question, Eric. So it's funny. Eric and I did the community the CRA program with Chase for a teacher that bought in downtown McKinney. And it's really unique because downtown McKinney, one street you have $1 million houses on, and then the next street you have $200,000 houses on.
Mm-hmm.
So for that program, there are sections of downtown McKinney that qualify for that Community Reinvestment Act. That program is more broad in its targeted areas than the targeted areas with the down payment assistance.
I see.
So each one of these programs is run by a different agency or a different group. So they're all going to have different targeted areas. Some of them are going to cross over, but they determine, like Chase determines the targeted areas for their program. TDHCA is run by Hilltop Holdings and is combined with a state agency. So they determine the targeted areas.
Excellent. Thanks, Will.
Yeah.
And to tag on to that, what Will just said, if you do have a listing in any of those areas and we find out that they are, this program would be good for that particular listing, let us know. We're happy to do some marketing materials that you can leave in the house just to let buyers know that there's potential for down payment assistance on this. Let's generate some more opportunities for people.
Yeah. And Elisa, thank you for your question. I want to answer it. So TDHCA has a separate program within its traditional down payment assistance. And so that program is for targeted areas. And when you buy in a targeted area, that's what generates that lower interest rate, buying in a targeted area, because they're trying to spur home ownership in these areas that are typically rentals, or trying to spur home ownership in a low to moderate income area. So by buying in one of those areas, you're being rewarded with that lower interest rate. I hope that answers your question.
Will, she did also ask about the credit score. Right above that, one has a credit score of 700 and the other has a below 600. Will that work? I'll let you answer it, but just want to make sure you saw that one.
Yeah, I didn't see that one. Thanks, Mike. That will not work. Unfortunately, on FHA, they do not have the program that will combine the credit scores. That is a conventional mortgage option. So with FHA, or a VA or USDA, they're going to take the lower of the two credit scores. But if you've got someone with a credit score at 600, it shouldn't take a significant amount of work to get above 620. We're happy to coach the client on what needs to be done to get it above 620 on their credit score. And it's really nice to have a program where your interest rate doesn't change based on the credit score. All you need to have is the bare minimum of 620. So everyone's getting the same interest rate. It's a really nice feature of the program. Anybody else have any questions?
Hey, Will, I would like you to address, because one of the questions I get all the time is people are always saying, hey, I want that program, I want that rate, I want that deal. And so how do we go through the process when we're dealing with a buyer to make sure that if that program is available, we give it to them?
Yeah, so like I said earlier, that's a great question. Thanks, Tom. Like we said earlier, every buyer is different. Their financial situation is different. So we've got to take an individualized approach to each client, and we've got to talk about their long-term goals and what's most important to them, right? So if they can afford the payment, if they're used to making a rent payment and it's $2,500 a month, they can afford the payment. They just are not great at saving money or haven't been able to save money. This program allows them to cover the down payment and a portion of the closing cost. So I think that's a huge win. And we approach it based on the aspects of the loan application. And there are some people that come to us that have money, right? But they want to take advantage of this program. And that requires some additional coaching. If you want to save your money and use the down payment assistance, that's great. Keep your nest egg. It took you so many years to save it. You can use the down payment assistance and just know that you're going to pay a little bit higher of an interest rate for the initial 3 years until you can refinance. So again, I can't stress this enough that everyone's financial situation is different. So we've got to approach each one individually.
Thank you.
Anybody else have any questions I can answer? I'm real passionate about these first-time home buyers. I really want to help them. They need all of our help. And right now, as you know, I'm sure you're getting the same objections I am. It is a scary market, and it's causing anxiety and every, I take a 5-minute break from work and I scroll through reels on social media as well, and it's all negative. Everything is negative. So I just trying to overcome those objections and provide options that benefits them is a challenge. And so we wanted to put together this program that can try to alleviate some of that concern about a monthly payment and cost due at closing. Everyone's real quiet, so you must be astonished at my ability to present this information and just taking so many notes that you can't even come up with a question. So that's awesome.
Will, would you mind touching a little bit too on what happened with rates this week? With the reports that came out with the feds that, just kind of address that so we have the most up-to-date information.
Okay. Look, I'm not going to paint a picture of unicorns and rainbows. So this week at the Federal Reserve met on Wednesday. One of the big things that they talked about is their last meeting, their dot, which they call a dot map. They expected to lower the federal funds rate 100 basis points in 2024. So that means lowering that rate that you hear about in the news, lowering borrowing costs for companies, home equity lines of credit, all that. Well, the economy isn't slowing down at the pace that they expected. So they changed that map to only reduce it by 50 basis points next year. So what that tells us is we are going to be higher for longer. That's what that tells us, that it's going to be a slower process for the economy to slow down. People are still spending money like nothing's changed. They are maxing out their credit card debts at all-time high. They're still spending money like that. Milk hasn't doubled in price and gas hasn't doubled in price. They're still spending the same amount of money, and it shows in all the data. So that shows the economy isn't slowing down, and we need it to slow down to bring prices back down, to bring everything back, inflation back down. So the lesson there is it's going to be longer. It's going to be higher for a little bit longer than they thought even 3 months ago. So it's just going to be a very slow recovery. And inflation is going to come down slow, and the price index is going to come down slow, which will drive interest rates to come down at a slower pace.
So the lesson is almost more concentrate on the investment versus the rate or the inflation in order to continue to, I mean, houses are still selling. And so it's just a matter of changing the message. Would you agree?
Yeah, I mean, the message is about it has been, and it should still be about long-term growth and long-term wealth, and what your goals are 30 years down the line, 20 years down the line. Because again, if I would tell you, if your goal is to buy a house and then move in 2 months, that's not a good goal. You're not going to make any money. It's probably going to cost you money in that short period of time. So now it's just a discussion that's more of a longer term investment. But there is opportunity. I think every one of the contracts that I've gotten in the past 3 weeks, they all have at a minimum of 2.5% in seller concessions, all of them. So, and they're all at list or below list price. So I think there's real opportunity to reduce their cost due at closing, use some of the unique programs like a permanent buy down or a temporary buy down to lower that payment, take some of the pressure off. And when rates do drop, we are going to see demand surge, right? Because that person at 3%, you're going to really have to incentivize them to move out of that house when their rate's 3%. So I think inventory remains a problem, and until interest rates fall, and then we'll have demand surge and prices will go up a little bit.
That's good. That's good.
Anybody else have any questions I can answer?
Hey, Will, I want to add something to that because there's some interesting stats that have come out this week that I think we need to mention. But number one, inventory levels are the lowest they've been in years. Rates are the highest they've been in 21 years. And what we see is still a significant demand in this market. And so the only thing keeping real estate even remotely down right now is interest rates. And so as soon as these rates do start dropping, I mean, the mid Freddie Mac rate was 7.5% this last week. As soon as these rates start coming down and inventories pick up just a little bit, I think you could easily see a 7 to 10% appreciation in real estate in 24 to 25. So for the clients that are saying, well, we're holding off, we're going to wait until rates come down, we're going to wait till there's more inventory, et cetera, I think they're going to be in for a rude awakening when that occurs, because you will see prices go back up as soon as these rates come back down.
Which should give clients a little bit of peace of mind, really, with this product that Will mentioned. When that is the case, the fact that this is a fully repayable product, at least you have some protection. If rates come down, you know that there's going to be that equity that they'll regain, you know, with having to pay that off. So that is at least a positive thing with this program.
Yeah, I mean, I agree, Mike. This is an opportunity. It's hard because, like I said, everything's negative, and I'm trying to be positive. But I think this can present an opportunity. Buying now presents an opportunity to earn that equity. If you wait till rates drop, you're going to be in a bidding war. There's a possibility you can be overpaying, and you'll move into the house with no equity other than your down payment. Well, now there's a chance to earn equity when rates fall and prices go up. That's your earned equity that will help them get that to that next house, that bigger house. So I think there's real opportunity right now, even though it's real scary. We've all got to overcome those objections. And if anybody wants to have a one-off conversation to go in a little bit more detail or check addresses, I mean, we're also happy to, if one of your listings falls into this targeted area, we can put together an analysis with our mortgage coach software so that you can have handy at your open house to show them what this program will do for their monthly payment. All right, guys.
Thanks, Will.
Again, let me know if you need anything.
Thanks, Will.
Yeah. Y'all have a great weekend.
No.